Hello and welcome to Pest Control Unlocked. I'm Konstantin Schwartz. Today we'll be looking at the results that Ecolab presented to us during the week. However, before we start, some housekeeping first. Nothing in this episode is financial advice. I'm not a financial advisor and I'm not offering you one's opinion. If you're making investment decisions, go and talk to a licensed professional who knows your situation. This show is for educational and entertainment purposes only. Everything I say here is my own view and nobody else's. I have no financial interest in any of the companies mentioned. Last episode, I made a prediction, and I want to start by marking my own homework. I said I expected Ecolab to give us an update on their connected device portfolio. And I said there was one question worth asking. What proportion of your North American contract portfolio is on the platform? And what was it a year ago? Ecolab reported on July 28th. We got half of that. We got a number, and it was a big one. But what we didn't get was the proportion or the previous year comparison. Now, here's what I found while I was preparing this episode. I changed how I think about the whole thing. First of all, I wasn't the only one asking. Go back to Ecolab's first quarter call in April. Mike Harrison, an analyst at Seaport Research, put almost exactly the same question to Christoph Beck. He asked what percentage of customer locations were using the new connected traps. Beck answered with a device count, about 700,000 at the time, and a story about a customer driving the rollout. He did not give any percentages. So this isn't me just being fussy about disclosure. This is a question the sell side has already put to the company. And the answer that came back was a number that doesn't answer it. This quarter, nobody asked at all. Today, I want to cover 3 topics. I will tell you what Ecolab reported because it was a good quarter. I'll show you what the filings reveal about what this transition is costing them, which is a part nobody has written about. And I'll come back at the end to the questions that are still open, because now I have 2. Let's start with a quarter. Global pest elimination did $350.5 million in the second quarter at fixed currency, up 9%. 7 of those points were organic, and the other 2 came from targeted acquisitions in North America. Operating income was $70.5 million, up 13%. Margin came in at 20.1%, and on an organic basis, 20.4%, up 90 basis points. Growth was led by restaurants, food retail, and food and beverage. So is 7% good? Ecolab's own long-term target for this business is 6 to 8%. So 7% sits right in the middle of what they told investors to expect. And Beck said as much on the call. The market itself is growing somewhere between 5.5% to 7%, depending on whose numbers you trust. On that basis, Ecolab is running at the top of the market range, in line or a shade ahead. But the direction of travel is more useful than any single quarter. Go back 12 months. On last year's second quarter call, Beck said pest growth had accelerated to 6%, with margins nearing 20%. Company pricing was 2%. This quarter, growth of 7%, margin through 20% at 20.4%, and pricing at 4%, exiting the quarter at 5%. Growth up, margin up, pricing doubled. 3 things moving the same way across a full year is a trend, not a spike. Here's the part I find most interesting. On that same call, Beck said U.S. restaurant foot traffic was down 5% year over year. That's down 5%. And the business grew by 7%, led by restaurants. That is not a demand story. Their customers were serving fewer people. That's pricing holding, contracts holding, and new business coming in the door. One caveat before I go any further, because it matters for any comparison you make. Ecolab's pest business is commercial only, and that is a deliberate strategic choice. There is no residential book. Now the part everyone in this industry actually wants to hear about. Beck said Ecolab has deployed nearly 800,000 connected devices at customer sites and expects to pass 1 million by the end of this year. His words on the call, no other company is there around the world. That's a strong claim, and from everything I can see in public disclosure, it's a fair one. But I want to slow down on that figure, because the interesting part isn't the total, it's the pace. Ecolab has given a device count on most of their recent calls, so you can line them up. In October of last year, over 400,000. In April this year, roughly 700,000. Now in July, nearly 800,000. From October to April, they added about 300,000 devices in 6 months. In the quarter just gone, they added about 100,000 units. The deployment rate roughly halved, and they still expect to reach 1 million by the end of December. That's another 200,000 in 5 months. Let me put that in terms that means something if you run routes. 200,000 devices across roughly 110 working days is about 1,800 installations every working day between now and the new year. That sounds enormous, but they have already run faster than that. The October to April pace was closer to 2,300 a day. So this is not a physical capacity problem. They can fit the traps. Which leaves the real question, why did the rate come down and what does that tell us? There are 2 readings and I want to give you both because I don't think this is settled. The first is lumpiness. These devices don't go out one route at a time. They go out as whole customer conversions. Beck has said the rollout so far has been driven largely by the world's largest retailer, one enormous account they developed the proposition with. On that reading, the fast period was a single huge project running at full tilt, and the slow quarter is simply the gap before the next one. The rate jumps again when the next big account signs. The second reading is that the easy accounts are being used up. The first 700,000 devices came disproportionately from one giant, centrally negotiated customer where a single contract moved hundreds of thousands of units. What comes next is smaller and more fragmented, regional change, single sites, where the sales cycle is longer and each location holds far fewer devices. I want to be careful here because the second reading is not saturation of the opportunity. Beck has said their technicians service devices numbering in the millions worldwide, which puts them maybe a quarter of the way through their existing book before any new single customer. And he has said the whole business becomes a pest intelligence business within 3 to 4 years. So this isn't the end of the runway. It's the anchor customer phase ending and the hard middle of the curve beginning. One thing tips me slightly towards the second reading. When Ecolab first gave a target back in October, it was more than 1 million devices in the first half of 2026. By February, it was simply 2026. By April, it had become year-end. The target slipped about 6 months, while the rate was falling. In fairness to Beck, he flagged this himself. He said on the April call that this won't be a straight line. But it does mean one thing worth being clear about. 1 million devices by December is not an operations forecast. It's a sales forecast. It depends on whether another very large account signs in time, not on how fast anyone can fit the trap. Now, a detail about this business that doesn't get talked about, and I think it should be recognized, that this is a business that they built. They didn't buy it. If you look at the balance sheet, the goodwill sitting against global pest elimination is about $190 million. Goodwill is what a company records when it pays more for a business than the assets are worth. So it only appears when you acquire something. It's a running tally of what a segment has spent buying other companies. Against roughly $1.4 billion of annualized sales, that works out at about 1/7 of the acquisition premium per dollar of revenue that Ecolab's water business carries. They do make bolt-on deals. 2 points of this quarter's 9 points of growth came from acquisitions. But at this scale, in an industry built on roll-ups, this business was mostly grown. And there is a number attached to what the platform is supposed to deliver. At their investor day last September, Ecolab put up a slide with 3 figures. Industry baseline, 90% pest-free. Ecolab today, 94%. Ecolab with pest intelligence, 99%. That's not a marketing claim floating in space. It's a benchmark with their own current performance sitting in the middle of it. And it's an outcome number rather than a service frequency number, which is exactly the shift I've been arguing this industry's standard has to make. Here is where the filings tell you something that the press release don't. In the first quarter 10Q filing, Ecolab broke out the margin bridge for this segment. Organic operating margin went from 16.6% to 17%, an increase of 0.4 percentage points. and then they showed they're working. Value pricing, higher volumes, and improved productivity contributed 5.4 percentage points. Investments in the business, including pest intelligence, took 4.9 points back. They earned 5.4, and then they put almost all of it straight into the build. I want to be precise because precision matters here. That 4.9 is a year-over-year figure. It's how much investment stepped up against the same quarter of a year earlier. It is not the total that Ecolab spends on this platform. That total isn't disclosed, and it will be higher. Even as an increment, though, it's a real number. Roughly 4.9% of about $307 million in quarterly organic sales works around $15 million in a single quarter on top of what they were already spending. And here's the thing I did not expect to find when I started working through this. The devices are the cheap part. Take 800,000 units, even at a generous price each, and Ecolab buying at that volume and designing in-house will pay well below anything you or I would. The whole fleet comes in below 1 year of that investment step up, and that fleet was built up over several years, not one. So if the hardware is only a fraction of it, where's the rest of the money going? Software, the data platform, cloud infrastructure, integration into service routing and customer reporting, retraining every technician who touches it, and the labor to physically install hundreds of thousands of devices at customer sites. That is the real cost of a monitoring transition, not the trap, everything behind the trap. There's one more thing worth knowing. Ecolab capitalizes this equipment, so it sits on the balance sheet and comes through the income statement as depreciation over time. That's completely standard accounting for equipment at customer locations. But it does mean the cash goes out through capital spending rather than through the margin. And this is an option you have when you're a $16 billion company with an investment-grade balance sheet. Also, Pest is one of 4 businesses Ecolab calls a growth engine, which is why a segment worth 8% of company sales gets funded like infrastructure. So what is this return supposed to look like? Let me go back to last year's call, because Beck said something then that I don't think got enough attention. An analyst asked him about the pest intelligence rollout, and Beck said this isn't just new technology. In his words, it's a new route model, it's a new financial model. We are not talking about a better mousetrap, a new route model, which is how the work gets built and scheduled, and a new financial model, which is how the business earns. He described the destination plainly too. Today, technicians visit every location, inspect every device. The target is remote monitoring around the clock, with people going where they can add value instead of checking empty traps. A year later, Ecolab put a number on that. At their investor day, they showed roughly 95% of a technician's time going to checking empty traps today, and about 5% to selling and growing the account. Their target state flips it, 5 and 95. Take that as an ambition rather than a forecast, but understand what it implies, because this isn't primarily a service quality play, it's a labor reallocation play. They're trying to turn a route technician into something closer to an account manager, and the sensors are what free up the hours. So when does that pay? On the quarters call, John Roberts at Mizuho asked exactly that. Does digital push pest growth into the low to mid-teens, and do you spend the margin improvement, or does it drop through? Beck's answer was sequential, top line first, and then he said something I keep coming back to. When you get into new technologies, he said, you need to create the right foundations first before you can really get the benefits. He prefaced that by saying it was a bit of a life sciences question. And that's the tell, because life sciences is the worked example and it's in the same transcript. Let me digress for a second. The life sciences business started in 2017 at under $100 million, and it's close to $1 billion today. Beck was candid that the middle years ran behind his own expectations, growing faster than the industry, but not as fast as he had planned. Here's the part that matters for us. He said reported growth in life sciences was mid-teens, while underlying growth was mid-20s, and that roughly 10-point gap was investment running ahead of the growth. Same mechanic as pest, different scale, identical structure, earn it, spend it, wait. And this quarter, life sciences grew 15% with a 26.5% organic margin and operating income up 46%. Beck said returns are finally back in line with what they expected at the outset. So the analogy tells you two things. It works and it took years. Which brings me back to that margin bridge, because you can now read it differently. Ecolab's pest business generated 5.4 points of margin from pricing, volume, and productivity. And what showed up in the reported number was 0.4. The underlying earning power of this business is running well ahead of the headline. And unlike life sciences, we don't have to guess at the size of the gap because they filed it. That is a business performing better than its own headline, choosing to convert the difference into the platform. It also hands us a signal to watch. Beck's own marker for a foundations phase completing in life sciences was underlying margins converging on reported margins. Apply that here and you get something clean. This transition is finishing when the investment line in that bridge starts shrinking, not when growth accelerates, and not when they announce something, when the gap between the 5.4 and the 0.4 narrows. That publishes every quarter in a filing, which makes it the most useful thing any of us can track. And Ecolab is still holding a 22% operating margin target for this business by 2027, up from 19% in 2025. So they are telling you they expect to finish the build and still get there. Let me get back to where we started. I asked what proportion of the North American contract portfolio is on the platform and what it was a year ago. What we got was a global device count, nearly 800,000, heading to 1 million. That is a real disclosure. It's more than we had, and it's more than anyone else in this industry has put on the record. But a device count and a penetration rate are different things. 800,000 devices tells you how much has been deployed. It doesn't tell you how many customers are covered or how fast that is changing. And the list of things we still can't see is longer than that. There's no revenue attached to pest intelligence, no attach rate, no average revenue per site, no geographic split. So we don't know how much of that fleet sits in North America against everywhere else. I don't raise those as complaints. Ecolab discloses more about this than anybody else. I raise them because they are the metrics that would let any of us judge whether a monitoring transition actually pays. And right now, nobody in this industry publishes them. That is a question for the whole market, not a criticism of one company. 2 dates I'm watching. The second quarter 10Q should file in early August, and I want one thing from it. The updated margin bridge. Second quarter organic margin expanded about 0.9 points against the 0.4 in the first quarter. So which side move? Did pricing widen or did the investment line ease? My guess is pricing. Ecolab exited the quarter at 5% and guided to 5 to 6% for the back half. And Beck said the investment continues. If I'm wrong and the investment line comes down meaningfully, then this transition is converting faster than management is letting on. That would be the more interesting outcome, and I'll tell you either way. The second date is November 17th, when Ecolab holds an investor day at the Supercompute conference in Chicago. Most of that will be about data center cooling. But if there is a pest update in it, that is where the penetration number could finally appear. So my question stands, and I'll ask it again next quarter. What share of the book is on the platform, and what was it a year ago? And I have a second one now, on deployment. Of the roughly 200,000 devices you expect to install between now and December, how many are already under signed contract? And how many of the 800,000 deployed so far sit with your 10 largest customers? Those two numbers would settle it. They would tell us whether last quarter's slowdown was the gap between big projects or the first sign that the easy conversions are behind us. I'll tell you in 3 months whether I called it right. In the meantime, though, Rentokil is expected to announce their results this coming Thursday. I will have a rundown of their results and publish it on the podcast early next week. Thank you very much for listening. Take care and all the best.